Hey, Simon, you are muted. Everyone, we got some technical difficulties. We'll be right back. All right, you're back. Sorry, everybody.
Technology. All right, everyone. I apologize. I had some technical difficulties on my end. It helps when the microphone is not muted, apparently better than when it is. Good morning, everyone. Today is Monday, August the 10th. Welcome to 7 Investing Live. This is our live stream event we host on Mondays, Wednesdays, and Fridays at 10 a.m. Eastern Time, normally with the microphone functioning and not muted. We put a highlight and spotlight on several of the market's most intriguing opportunities. In fact, that's what 7 Investing has done since we were founded back in March of 2020. We find innovative stock market opportunities, we deliver them directly to your inbox, and we're helping to empower individual investors. So I encourage you to check out 7investing.com. In fact, if you go to 7investing.com/subscribe, you get your first 7 days completely at no upfront cost, completely free and with no strings attached. So check it out. Check out our newest August recommendation while you're at it. Heather, we like to talk about fun stocks that go up. We like to talk about companies who are doing well and growing their business and beating Wall Street expectations and reporting great earnings. But unfortunately, that's not what we're going to be talking about here this morning. We're going to be doing quite the opposite. Pardon me as I go into glass half empty mode, and we talk about the most recent report from the TradeDesk. The TradeDesk is TTD for anyone who wants to follow along. You're most likely familiar with this company. It was a long-time stock market darling. It actually outperformed the market for several years, but it's been struggling. It's been struggling a lot in 2025, and it's been struggling a lot in 2026. And I think with our second quarter results that we just got from the business this last week, now's a good time to perhaps step back and say, okay, objectively, what's going on with the TradeDesk? Why are we underperforming those expectations that they laid out there for Wall Street? And is this still a good opportunity for investors? Those are some tough questions. Let's start at the top, though. Let's look at the stock chart for the TradeDesk itself. And we mentioned that this was kind of a market darling for a long time. It's been one of the best performing stocks for individual investors out there. This is a digital advertising innovator. They're running a demand side platform that is helping large agencies. You can keep it up there if you'd like to, Heather. I like to look at that stock chart. It's helping advertising agencies place the right ad at the right time for the right person on the right medium. So that could be on websites, that could be in podcasts, that could be on connected television stations. And if you look at pretty much all years up until late 2024, this was a stock that went hyperbolic there for a little while, right? From $13 a share kind of in 2017 up to 10x that, over $130 a share in late 2024. If you can get a 10x return in a 7-year period of time, you're doing quite well for yourself in the stock market. And the trade desk just continued to outperform expectations each and every quarter and outperform its top line growth. But if you look at what's happened here in 2025 and then 2026, we've reverted all the way back to those 2017 levels. Basically, I've given up all of the gains, and the stock price has dropped 90% in value between late 2024 and now in mid 2026. That is accompanying even growth in top line revenue and pretty reliable earnings and cash flow growth as well. It's still a profitable business. So what is going on with the trade test today? Why has this stock that was one of the favorites in the market for almost a decade now struggling so badly? Why did it give up 9/10 of its value in the last year and a half? The clues to that answer lie in its second quarter results. We just got second quarter 2026 financial results from the trade desk. We can pull those up if we'd like to take a look at them and talk about them, but they're pretty terrible all across the board. This was a business that has slowed in its revenue growth. It has decelerated in its earnings growth, and its profit margins have also declined as well. This is an independent digital platform that, again, is helping ad agencies to place the right ads in front of the right people. And it's almost entirely a transaction-based model, right? When its ad agency customers are doing well and placing lots of ads, the trade desk takes a 20% take rate, blended average, of those ads that are placed, right? So if you're placing a video ad on a connected TV channel, the trade desk is going to take a cut of that. If you're seeing an ad that's placed over an internet site or within a podcast, they take a cut of that. But when advertising slows down, the trade desk makes less money. And because it's all independent, it's dependent on those ad agencies to make more ads, to increase their digital ad budgets, to get more people advertising. Again, this is a very consumer-facing platform. So when consumers are in a tough time, you can see the numbers slow down. Up at the top there, though, look at the revenue growth. We went from 19% year-over-year revenue growth in the second quarter of 2025 to just 3% growth in the second quarter of 2026. And of course, when you have slower advertising growth at the top line, that impacts the margins too, right? Look at the net income margin going from 13% to 9%, adjusted EBITDA margin from 39% to 34%. There's a lot of fixed costs in the development of this business. This is a platform that scales incredibly well when things are going well, but also suffers when things are not going well. And so Jeff Green, the founder and CEO of TradeDesk, comes out and says, hey, this is macro related. We're selling to consumer discretionary spend, travel agencies, gyms, consumer products, the things that are right there in front of consumers when you're watching TV on connected TV from your couch in your living room. And so when this slows down, maybe that's due to inflation, maybe that's due to tariffs, maybe that's due to just consumer discretionary spend being lower when energy prices and gas prices are higher. He says, hey, this is something that we're well aware of, but we do not think is permanent. But here's the problem, though. I understand that this is a tough macro. I understand that consumer discretionary spend is lower. But the trade desk, after hitting earnings estimates for 8 straight years, every single quarter for 32 quarters in a row, missed last first quarter of 2025. This is the first time they had missed in 8 years. And now we're in the second quarter of 2026, and they've missed those same estimates again for the past 2 quarters in a row. There needs to be better guidance with the street if you're going to miss 2 quarters in a row like this. There's a lot of uncertainty from Wall Street and a loss of credibility from Jeff Green, who used to always beat and raise every single quarter. Now we're in the opposite. We're seeing a miss on earnings and revenue that was expected by Wall Street, and it's causing a lot of uncertainty. And I think that when there's uncertainty for an innovative, smaller company like this, that's the worst thing that can happen. And that's why a lot of these funds have pulled their stakes. They're saying, we're out. If you can figure this out, that's great. But you're not going to keep us on board if you're only showing 3% revenue growth. The other problem was the guidance. They also came out and said with their upcoming third quarter, they issued revenue guidance that would actually decline in year-over-year revenue growth. That's the first time in a long time we've ever seen the trade desk reporting negative year-over-year revenue guidance. Perhaps they're just sandbagging. Perhaps they're just setting the bar as low as they possibly can here because they don't want to miss again for a third quarter. But it doesn't look good when you missed expectations for 2 quarters in a row and you also got an issue very, very conservative third quarter guidance coming out. Another thing that happened that I think that is a big problem with what's going on is the trade desk serves the largest ad agency customers. They want to go out there and go after the agencies that are working with large consumer facing brands, get very, very large campaigns and good budgets, and then work with these higher priced clients because they're going to be able to do a lot of things that other agencies cannot. Agencies cannot do with other DSPs. Worked in their favor for a decade, for more than a decade. But back in March, we got a little bit of a rumbling, a little bit of a kind of a spat between the trade desk and one of its largest customers called Publicis. Publicis, if you are French, this is one of the large advertising agencies out of France. And they came out and they realized this was not something that was publicly disclosed. It was from a memo that was kind of being sent around internally. But we saw there was a feud going on between the pricing that the trade desk was charging to Publicis. The Publicis actually did an audit on the fees they were being charged, especially for some of the AI related products that the trade desk was charging them for, that they thought that they shouldn't be charged for. And then even worse, they thought they should be charging their clients for on their own behalf. This is a bigger picture, longer term issue that the trade desk is going to have to address in a way that builds credibility and faith with Wall Street. Because when you have very, very large ad agency clients, the trade desk can do some incredible things. You know, it's got all these variables and all these inputs it can use. It can unleash its AI on making sure the campaigns are being run very efficiently and that you're getting a really, really good return on your ad spend. But sometimes when you're going out there and doing disruptive things to an industry that is $1 trillion in addressable market size, it makes sense that the largest customers don't want to lose their own income stream that they're charging to their advertising clients. They don't want to be displaced by AI. They don't want the trade desk to automate a lot of the roles that they're having as well. And there's been kind of this dance between what is the role of the trade desk to improve the overall return on ad spend. You want that if you're an ad agency, but then you don't want the trade desk completely replacing you and charging fees that you certainly were not aware of what you were being charged before. And so this finally got settled out. You know, the terms were not disclosed, but they did reveal that they actually settled this disagreement here within the past month. But I feel like it's left a black eye in the relationship, and it's introduced new questions of how should the trade desk be charging its clients? What are the fees that are being packaged in there? Are other large clients going to start doing audits like this as well? And most importantly for us as investors, can the trade desk continue to capture a 20% take rate going forward? The take rate being the percentage of the overall advertising spend that goes across their platform that is taken, that is captured by the trade desk as its own company revenue. 20% is very high, especially for a transaction-based model like this. We've been typically used to seeing this in reservations for hotels and airlines and online travel agencies being closer to 13 to 15%. 20% for advertising showed that the trade desk was leaps and bounds ahead of its own competition and able to justify those prices. I think personally the take rate is going to be coming down, and we're going to be looking at that a lot more going forward in future quarters. We have another problem. Houston, we have a second problem this time. The second problem is not just the take rates and the deal with Publicis finally putting some transparency on some untransparent practices and pricing, but you've got a really large competitor coming in whose name is Amazon. And by the way, the most terrifying thing you can possibly hear if you're the CEO of a smaller company is Amazon is now competing against us. And Amazon does now have its own DSP that's launching, that's competing head to head against the trade desk. Here's a review. This is some third-party research. This is not 7investing's research, but I do really like the comparison of what the trade desk is offering for their DSP versus what Amazon offers in their own DSP, right? So first of all, Amazon has got a ton of ad inventory out there, right? Amazon Prime, all the channels that Amazon's got on its own, you know, its own video channels, on its own advertising within its own platform, within, of course, the Amazon e-commerce site itself. You've got a lot of kind of behind the walled garden stuff that's just part of their own ecosystem. But they're starting to open a lot of that up now too, so you can be an independent DSP. Basically saying, hey, if you want the walled gardens, you want us to control the experience, it's a little bit less transparent on you know how we're using it, but it's going to be on our own inventory. You've got that option. Versus Amazon is now saying, and by the way, we're going to do a lot of the same things that the trade desk is doing too. We're going to have our own DSP. We're going to put it out there, and guess what? We're only going to charge 10 or 11% of the take rate, as opposed to the 20% plus you've been paying with the trade desk. So this is a huge problem, right? If you have an independent DSP that was operating without any competition, Trade Desk was able to capture very, very high prices, very, very high take rates. Now all of a sudden you've got Amazon doing a very similar, if not identical, function with its own independent DSP. Independent in this case, meaning not within its own walled gardens, but opening up a lot of that inventory for it to be bid across the open internet. This is an issue for the Trade Desk that they didn't address substantially early on, and now they have to come back and they say, Jeff Green is going out there to his customers saying, hey, do you want to work with an independent agency? Do you not want Amazon to have all of your data, your shopper data, your first party data? Are you worried about them competing against you? We've told that story for several years, and it's resonated with customers. Brand safety, another big one too. How is this being placed within the platforms? But I think that really the metric that matters more if you are a large agency is, what is your return on ad spend? And are you okay with Amazon being a walled garden, being that they're right there next to people who are clicking on the buy button on the Amazon website, where they know exactly what kinds of shows people are wanting to watch on their video stations? This is something that's been a platform that Amazon has monetized incredibly efficiently for a very long time. It makes sense that advertisers want to spend their money to appeal to consumers there. And I think that Trade Desk is going to have a harder sell on convincing agencies to work with them instead of Amazon going forward. Keep in mind, we're at 95% client retention for the Trade Desk still very, very good metric. It's been over 95% for most of the past decade. But I think that's not a given going forward anymore. I think that the rumblings with Publicis and now Amazon being a new competitor, there's just been a shakeup of the technology and the innovation in this industry, which we know moves very, very quickly. And it's going to be harder for the Trade Desk to capture the same margins going forward. So that's what's happened. Let's talk about what's going to happen going forward. Jeff Green has been very busy in hiring a new team of C-level executives to enact a new strategy for the Trade Desk. In fact, just last month, within a 3-day period in the middle of July, they hired 3 commercial-facing executives that are right there in the C-suite that are directly reporting to him. Right, they hired a new chief commercial officer. They hired a new vice president of client strategy and a new chief business development officer. A lot of these executives are coming from Google or from tech companies. They know how to work efficiencies. They know how to run large platforms. They know how to go after really, really large customers and give them self-service capabilities. Right there, you can see kind of all the new appointments that they've had. Jeff Green has been welcoming a lot of people into the Oval Office and the running of the ranks for the Trade Desk management team. These are client-facing roles, right? These are going to be expected to quantify the benefits that the Trade Desk offers to the largest clients. In a lot of ways, this reminds me of what Splunk did a decade ago. They would go out there and they'd send teams to customers, large customers, and they would basically just relentlessly quantify the ROI of their platform. They say, hey, if you work with us, this is the kind of returns you're going to see for yourself. This is the type of revenue you're going to see as a benefit from working with our platform. And then eventually small customers would take a bite at first. They would grow that and expand to larger teams going forward. And then all of a sudden you've got an entire enterprise that's working with Splunk because it makes sense for both groups. I think that's the playbook that Jeff Green wants to work here. I think that's why he's going out there and hiring tech executives and putting them into customer-facing, client-facing roles. If this works, it's going to be great. The Trade Desk is big enough now that it can go after those really large customers that might be working with Amazon, that might be working, independently. You want to go out there and quantify for ad agencies, hey, look how much money you can make if you're working with us versus if you go at this on your own. But if they don't, this is a lot of money they're spending, and they only reported 3% revenue growth last quarter and are predicting a decline in revenue for the third quarter. You got to do better than that. Jeff Green, I admire him going out there and seeing that things are wrong. He says he's got a handle on what's going on. He's bringing in a brand new team, some new blood to actually push this business forward. But there's still a lot of uncertainty right now. There's no guarantees, even with the new team, that this is going to work. And keep in mind, Jeff Green is a disruptive guy, right? He's going out there and going to be rattling the cages in a lot of ways and shaking up this industry, he might not see to eye with these new C-level executives. If we see some of them jumping right back out or saying, hey, this just wasn't the job that I thought it was going to be, could be a red flag that Jeff does not have the same pulse on this industry as we've known that he's had for over a decade. So let's conclude this, and then I'm going to open it up for some questions, either from the live audience or Heather, if you have questions about this as well. But let's look at the valuation, right? The trade desk, if we look back at that stock chart again, is now back to $13 a share. Again, a 7-year low. The market cap of $6 billion is basically the lowest that we've seen since 2018, excuse me. This is, it feels like it's a buying opportunity, right? When you see a company that's got the kind of firepower and the gunpowder that it's had, that has the ability of going 10x in a short period of time, you want to immediately jump in and say, okay, now's the time to start buying, right? This is a strong buy. Let's go in with a trade desk. And I really like this company because I liked Jeff Green, especially in 2025 when I saw this stock selling off. I was convinced he was going to turn things around. I believed him that the macro was difficult, that the trade desk had their finger on the pulse of what was going on out there. And unfortunately, it's just continued to get worse in the last 6 months or so. I did not anticipate them missing quarterly revenues and earnings for 2 straight quarters. I did not anticipate them seeing a decline in year-over-year revenue predicted for the third quarter coming up here. We need to see the growth resume. I'm hopeful. The best case scenario is that these are short-term speed bumps that the trade desk has to renegotiate some terms with its largest customers. They put Publicis in the rearview mirror. Hopefully, the tariffs and the consumer discretionary spending is going to improve in coming quarters. And I would love to see the trade desk get back to 13, 15%, even 18% revenue growth. That's how, when a couple of weeks ago, actually, I guess it was more like 2 months ago now, when we came out and they said, hey, I can make a case for the trade desk being worth $40 by the year 2027, 2028. That would be fantastic. That'd be a triple from today's prices if they did that. But if we're stuck here in, low single-digit growth or even negative year-over-year growth, the stock is priced appropriately at $13 a share. $6 billion market cap, unfortunately, is reflective of Wall Street saying, hey, you got to prove it to us first. If you're going to be stuck in kind of this stagnant growth rate or even declining growth rate, and you're not significantly pushing the top line and the take rates are at risk all of a sudden, I think that the stock actually feels pretty appropriately priced right now. We have to see this return to growth. I would love to be optimistic and say I think it's going to happen. But, when uncertainty and risk is high, it makes sense. It is justified for stock to sell off like this. So, Heather, I'll open up on that. I think that the long and the short of this with the trade desk is this was a great company to own for a decade there. It just did so well. It executed so well. It didn't have any competition. It did exactly what it said it was going to do. You saw all the financials and the fundamentals just kind of going up and to the right. And now, we've kind of thrown a wrench into the plan there. We've got a lot more uncertainty going forward. And it's going to be up to this new leadership team to show that this company is credible and then get it done here in the second half of 2026.
Yeah, I left this chart up for a second because one of the things about this industry is that there's always this volatility because, as you were saying, like ad revenue and ad placement is very dependent on the economy. And that's something I haven't really thought about much before now about companies like Amazon who are doing this, but also have other more stabilizing. There's a lot of money here, but yes, it can be very fluctuating. So that one's interesting. It is really just, this was such a stock market darling, and to see it at $13 a share is just pretty wild.
It's so crazy. It feels like it was so long ago that we were all so concerned about the third-party cookie. Do you remember these conversations? It feels like ancient history now, but it was even just a year or two ago that everyone said, the deprecation of the cookie, we're getting out. This is something that we have privacy concerns. We don't want Facebook following us around the internet anymore. Google was phasing it out. They were going to use a new identifier, and it's just perfect. The trade desk was like, hey, we're using our universal identifier. It's open source. It's encrypted. Security is there. The data privacy issues aren't there. Don't worry about Facebook and Google stealing all of your data, as a consumer. And then even for the agencies too, it's like, don't worry about Amazon copying what you're doing with their own knockoff product. Those are not the same conversations we're having this year anymore. the same things that made the trade desk so lucrative and so appealing to work with in 2024 and before are a different conversation. In fact, my own phone right now is trying to get me to talk to it because it hears me talking about what's going on out there. Um, Maybe that's not the same conversation anymore. Maybe it's now a return on ad spend that really just matters. Now, is that because it's a tougher year and ad budgets are crimped? And, you really want to get the best bang for your bucks? You're going to say, I'm going to work with these guys I didn't want to work with necessarily a couple of years ago. Well, times are tough. They're giving me the best return on ad spend right now. I'll work with these guys. Does that shift back to the trade desk going forward? When the ad budgets get larger, and we're going to see, from what we've seen, 95% client retention is still in place. They haven't lost their large customers yet. They had a spat with Publicis, but they hadn't lost their large customers. If they do, that could be really bad, but it could also be really good. We don't know which way this is going to go in the future.
Yeah, we had a conversation just a couple months ago where the biggest concern was for a lot of customers was going to someone like Amazon who could be competitive, but we're getting to the point where it looks like where yeah, budgets are so tight that it's just not really people are willing to give up some of their information for a good discount. I am hopeful that the new C-suite really helps out because we've seen it. Jeff Green's been pretty successful about turning this company from like a high growth kind of disruptor into a stable company that is still disrupting the space. Some CEOs have not successfully made that transition. He has, and so hopefully he'll be able to navigate these waters going forward.
That's right, and these waters are getting incredibly murky, right? If you look at the waters of digital advertising and all the steps that are between a company wanting to place an advertisement that they have ready to go and somebody clicking on a website that's ready to see that advertisement or listening to a podcast or watching, a media station, TV station like that. There are so many middlemen between those 2 points, so that for every dollar of ad spend being borne by the advertiser, only about 55 cents of it is actually getting to the placement of the ad in front of the customer, right? There's this interwoven platform of exchanges and supply side partners and then demand side partners and then the data analytics in the middle. It's like it's scraping out so much waste and in this entirely complex digital advertising spend. And you would what's happening is exactly what you would expect is happening is you're kind of nudging out the unnecessary parts of this toll booths, right? You don't need that many players. The most inefficient players are getting nudged out, and that's why you see companies in this space going bankrupt all the time or getting acquired all the time. We have other companies we've talked about with 7investing within digital advertising, right? The appeal is there. These can be incredibly efficient, and you can have incredible operating leverage when times are going well. But when times are not going well, or like the industry turns on you, you're just not able to compete because this is a fast-moving industry as it is. You get nudged out, and so that the waters keep getting smaller and then more shallow every year. Right? There's fewer and fewer players in every one of those boxes. The trade desk has remained. I mean, they're still growing. You saw the revenues are still growing, the earnings are still growing. They're consolidating their power out there, but it continues to get harder. You're not against these small fragmented, smaller competitors anymore. You're up against Amazon now. You want to compete against Amazon, you better bring your A game because they're bringing theirs.
Yeah. And then finally, because we're running low on time, how did last time we talked about Trade Desk, we talked about their kind of disruptive AI new system. How is that going? Have we seen any results from that?
This is a contentious question, or controversial, I would say, because Jeff loves to talk about how wonderful Kokai and Koa are, his AI platforms that he's embedded into it, right? Which I believe a lot of these are kind of surfing terms. They're big on surfing. They're out in Venice, California, so they love to bring in these fun surfing terms for their products. Neat fun fact, trivia fact. He loves them. He always talks about how wonderful they are. But if you actually talk with an advertising agency executive, which I have, a lot of them say it's very expensive, right? It's been the best in class for a long time. Amazon's is not as good as a trade desk still today, but are you going to pay 20% to the trade desk to be you're handling all this for you? If you don't have to, if you get something that's almost as good and you're only paying 10% take rate instead of 20%, eventually, especially those smaller agencies are going to vote with their dollars. This is going to be an economic decision. This is not just a philosophical, you want to work with them. There's money at play on this. And so, to the question of, is the AI working? Yeah, it's working. From as I understand it, it's still best in class, at least for what it's doing out there. But I think it's getting harder, and I think maybe there's the delta, the gap is getting smaller from where they used to be 5 years ago.
Gotcha. That makes sense. Yeah, I mean, especially in this economy, no one's going to be people are tightening their budgets, and trade desk sounds like that's going to be hurting them in the going forward as well.
Yeah, and the analytics too, right? So much of this was the analytics. It was so good to have a platform to keep all the analytics and all the angles that you had before. With AI now, it's almost like that's becoming less important, right? It's just going to work, and AI is going to tell you the numbers. You can ask in a command prompt what went well and what went poorly for free, and it'll tell you these things that used to be kind of buried within these silos of these data. Just a different world we're in now, and unfortunately, Trade Desk is one of those companies that disrupted the industry, but has now got a lot more competition. Things are a lot harder.
Yeah, like you don't really need those back end dashboards anymore because you can build one in an afternoon.
Absolutely, absolutely. So that's the trade desk. We'll wind it up there. I want to close out the program here at the 30 minutes past the hour. TTD, if you want to follow along the trade desk, you can also follow our coverage of this company at 7investing.com/TTD. And you can even go back there and see some of our previous reports on the company. We've tracked along pretty well with what was going right with the trade desk and objectively what's not going right, even back into the beginning of 2025. We pointed those metrics out. A couple of red flags have certainly emerged, but I tend to like Jeff Green going forward. We've brought it on this show. We called out a lot of things that they haven't been doing very well here, especially from the fundamentals perspective. I still like this innovator of the industry. I still like Jeff. I still like what he's doing out there. It's going to be real interesting to see what this new team enacts here within the next quarter or two. They know that the fire has been lit and they've got to make some changes. This is a very busy week. We have a lot going on. Rocket Lab reports today. We're going to be looking at that probably on the next show that we host. We're also going to have a follow-up on Duolingo and SoundHound, which we correctly predicted that short squeeze. I hope anyone watched that show from a couple of weeks ago. Played out perfectly, and we're going to do a follow-up on what happened with that and why it worked out the way that it did too. And then we'll probably hit a couple more earnings coming up here. There's been a flurry of activity for the good and for the bad. Unfortunately, for the trade desk, it was on the glass half empty side of that. But a lot coming up. I hope that you have a wonderful Monday today, and we'll see you later this week. Have a great day.